Stuart here again. It's Monday, the 23rd of March, 2026, and I'm about to do a one of my favorite webinars. I've been talking about this for well over 20 odd years. You know, knowing yourself is by far the most important thing if you want to be successful in this game of trading. If you trade a time frame that doesn't fit your psychology, if you trade an asset that doesn't fit your psychology, if you try to do something outside of your natural strengths and weaknesses, you're always fighting against yourself, not the market, not your broker, not anybody, not gurus, or and certainly not old guys like me suggesting what you may do. It's about understanding yourself. It's about beating yourself. If you want to talk about in beating terms, but success in trading is really very much a mindset and a mind game. When I used to work for a highly regulated broker, not that we do anything that's not highly regulated here at the proptrade.com, but the compliance department there were always nervous about me saying it's a mind game, using the word game, but it is, trading is a bit of a game, and it's a game against yourself. First and foremost, if you understand the principles, you understand the basics, anybody can learn that. Anybody can press buy, sell. But it's understanding yourself. That's by far the most important thing. So these are the slides I'm going to use today. Ones we did last summer, the psychology of the funded trader. So let me just make myself a wee bit smaller so you can see the slides a wee bit better. There we are. That's better for the whole screen, isn't it? You don't see as much as me. So obviously, any questions you guys have got, please click on the chat box and I'll stop. I think there's about 50 slides here. I'm not going to talk about all of them all of the time, but if you want some sort of a cut down version, let me know, and we can certainly see if we can share some edited highlights of today. But because this is absolutely key to success in trading. And the beauty of the prop trade is that our rules and regulations is the wrong word, but our rules keep you on the we're after disciplined risk aware traders. They don't gamble all on one big trade. They're doing things in a structured, organized a way. They're not sort of revenge trading, or they're not trying to. They don't think the market owes them, so they're not going for big wins, having had a lot of losing trades. So let's crack on. There's lots to get through today. It'll be probably over an hour today. So thank you for staying with me. If you stay with me, if you're watching this as a recording later, obviously you can skip through the bits that you find more interesting. So let's get going. So my name is Stuart Cowell. My background is in the City of London. I work for a number of banks in the City of London for well over 20 years. I worked for a number of European brokers when I was out in Cyprus for 12 years. And now I'm back working with the proptrade.com. I'm back in London, principally for personal reasons. But my mantra has always been that third line there: probability, simplicity, and timeframes. Always do what is probable and keep it simple. It's all in the numbers. So if you understand the basics of spread and leverage and all that sort of good stuff, you can make success of this trading lark, this trading game. But fundamentally, you have to know yourself. That's first and foremost the most important thing when we're trading. So just excuse me, I haven't got a drink. I'm just going to go and grab my bottle of water. Because I'll be chatting on. I've just had an interview with somebody as well. So excuse me. So always do what's probable. Keep it simple. It's all in numbers. That's if you get that. If you take anything away from today, take that away and have a think about it. Some great books I can recommend as well as we go through the session today. Some you'll have heard of, some you may not have heard of. So what we're going to look at today: how to improve your trading mindset, understand the importance of trading psychology, how to stay afloat on the trading ocean. Call it a trading ocean because it's trading world now is 24 hours a day. I mean, the major exchanges, the NASDAQ, the FTSE, the DAX, even the Nikkei, they're all talking about going to 24-hour trading. Years ago, People said that's not going to be possible. The liquidity, the providers aren't going to be around 24. They can't do it 24 hours a day. But with the current world we're living in and the current state of the world today, the 23rd of March 2026, as things change literally sometimes by the minute or by the second, 24-hour trading is really coming along. I'm pretty sure of that. So trading psychology, the trading ocean, and thinking in percentages and probabilities. Don't think in making dollars or losing dollars or points and pips if you prefer, but think in percentages and probabilities. That's what the professionals do. That's what the long-term traders do, and that's what I do every single day. So any questions, obviously, chip them in now or as we're going through the session this afternoon. So I'll say, I hope you're well. It's Monday. It's not a great deal of market moving business. First slide. It's a mindset business. So you need to look yourself in the mirror. How do you deal with risk? How do you deal with losing? How do you deal with winning? You as an individual, you as a person. Okay. That's who you're beating. That's who you're up against. It's not the market, as I said earlier. It's not the broker. It's not the FTSE going up and down or the price of gold going up and down. It's you're dealing with it. How do you deal with winning? How do you deal with losing? Think about it. Write it down. Practice it. Say it out loud. That's a great way of bringing subconscious thoughts to your front part of your brain, your conscious brain. It's a mindset business, and anybody can be a success in the trading business. Wherever you are in the world, whatever your belief pattern, whatever religious belief you have, whatever fundamental belief you have, anybody can make a success of trading. It's not about technical analysis, fundamental analysis. Whether you're a trend following, whether you're a mean reverting type of trader. It's not the broker. It's not the spread. It's not gurus you see on YouTube, the latest whiz kid, the latest guy with 50 years experience. Webinars, seminars, robots, algos, expert advisors, whatever it is, your platform, TradingView, Baby Pips, the calendar, Bloomberg, Reuters feed, Amazon, Apple, particular companies. It's all about you. It's a mindset business. Trading is a mindset business, and it's about beating yourself. Get that. I say, if you don't take anything away from this afternoon today, get that and take that away and have a real good think about it. That's the most important thing. It's not all these other things that the market and the marketing companies might get you to believe. There's lots and lots and lots of free advice from really, really good people out on the what was Twitter sphere is now the X platform of sort of stuff on X you wouldn't want to see. But Stephen Goldstein, for instance, it's all about. He's a great one. He's written a great book. I think he's amending it and updating it over the next 18 months. But anybody can make, as it says at the bottom there, anyone can make a financial gain. The psychological, a positive, negative hit to your ego, and the emotional consequences of that. They're the two key elements of a trade. You win or you lose. You break even. So you want a big win. You want a small loss when you lose. And that's what keeps you in business. That's the only outcome, isn't it? But the impact is the actual gain or loss of the monetary value. But then it's the psychological impact, and that's what we're going to talk about today. Can you cope with winning after winning after winning? I know that sound like really, really strange things to say, but again, there's the techniques, and there's the way the chemicals in your brain react when you're on a very strong winning streak. You think you're invincible. You think top of the world. Anything I touch is turned into gold. And the flip side of the same coin, you're a long run of losing trades. And how do you deal with that? So it's all about the emotional impact, both to you, ego-wise, but also physically, about losing money, making money. It's about the psychological element that's absolutely fundamental to staying in business for any length of time. Lots of people think it's a very straight line. This is we're going up and down all the time. Steve Burns, another great free spreader of news and information. This is where I first got this idea about a small win, a big win, a small loss, or a break even. They're the 4 things you can do with a trade. They're the only 4 outcomes you want. You don't want a big loss. You want a big win. Small win's good. Too many people still go bust only having small wins. It's possible because they're then lots and lots of small wins, but then have a massive loss that wipes it out. That's very, very common, both for new and experienced traders. Trading is not about predictions, options, or great calls. Trading is about maths, risk reward ratios, winning percentages, and position sizing. All that sort of stuff is simple numbers, maths, risk reward ratios, winning percentages, position size. All of that you can control. You can't control what the market does once you're in the market. The price will go up or the price will go down. That's it. That's all it does. Or the price will not go anywhere. How you deal with it emotionally and psychologically, that's the key thing. All the other stuff you can work out. The algorithms can do all this sort of stuff, the maths, the risk reward, percentages, the position size, and there's some great bits of software that do all that for you now. You don't have to write stuff down like I had to when we first started. But as far as what's going on inside your head, your subconscious as well as your conscious brain, algorithms can't help you with that. It will eventually, but currently it's all about you, and it's about controlling that. Steve Burns, another great guy to follow. There's Goldstein again, and Mark Minaviri, a legendary trader. My guiding rules for trading are: don't force trades, don't have big losses, never average down, don't skip steps of the process. It's all about process. Trading psychology is often considered as separate from trading process. It's not. It's ground zero for trading. These guys know what they're talking about. They've been there, they've done it, and they're teaching others, they're trading others. They're all mentors for other people. Okay? So about finding yourself, go out, investigate, see how you're dealing with your long winning streak, see how you're dealing with your long losing streak, see how you're dealing with your winners, you're losing, you're winning, you're losing, flat weeks, flat months, always analyze everything. Some of the books I've got a whole host of trading books. There's only a few on here. The Reminiscence of a Stock Operator, absolute classic story of Jesse Livermore, the boy trader. Relatively high risk, but he blew. He made millions, hundreds of millions of dollars back in the 1920s. He blew it 2 or 3 times, and he committed suicide, unfortunately, before he got to 40. Legendary. People say, did he really exist? Yes, he did. He was a real person. The best book, in my humble opinion, about trading psychology is this one here at the bottom of the screen here, Trading in the Zone by Mark Douglas. His first book, The Disciplined Trader, was a bit drier. Took me a long time to get through that book. I think I've only read it once or twice over the years. But a few years later, his writing style changed a tad, and Trading in the Zone became an absolute classic 25 years ago now. And it really does focus the mind. I don't know anybody that's read it more than once or twice who doesn't hold it up there. It's not in their top 5 trading books of all time. It certainly would be, certainly my top 3, if not, if I had one trading book, it'd be this one, probably above Reminiscence of a Stock Operator. But Trading in the Zone is the one that pushed me to be the trader I am, investor I am today, to be honest. Obviously, all of these are really, really great books as well, all about the trading world, and there's lots more as well. Markets overreact, whether they're going up or going down. This is the pandemic back in 6 years ago now, March 2020. Massive losses on the Friday, March the 12th, 9.9% there on the Dow on the 12th of March 2000. 12% decline on the Dow the following week on the 16th. So massive declines. Once panic starts ensuing, it creeps in. 2,300 points, followed by nearly 3,000 points on the 16th of March 2020, 6 short years ago today. And this is all about, fundamentals as well as, the psychology of the market, everyone selling, everyone going in one direction. Massive moves, 12.3% on the NASDAQ in one day, nearly 12% on, the world's most important stock market, the S&P 500. So 9.5% on the 12th the 16th, a few days later, another 12% crashing off. So we closed here on 24,000. 2,418. We were down here at 2,386 a few days later. Massive, massive moves on these key equity markets in the United States. As Livermore wrote, or it was quoted as writing, he didn't actually write this book. Edwin Levere wrote it. Money is made from sitting, not the doing. So it's not a straight journey. It's about finding yourself, and we all go through these swings in emotion from euphoria all the way down to doom and gloom, and nothing really happening. It's all about staying in business and coping when you're under the profit line, and not being overconfident and pushing things too hard when you're over the profit line. It's about getting there. Basically, it's not, as we saw on that other slide, it's not a straight journey. So as somebody that's been doing this for 30 odd years, I call this my dirty dozen, these 12 examples. What happens with our trades? What's your score? I've written here. And I could easily have written 20 examples or 30 examples, but these are my top 12. So if you're watching this, get a piece of paper and a pen and write these down. Tell me, or tell yourself, again, remember, it's you. You've got to convince. It's you've got to beat about how many of these you've done as a trader in your career. And I've done all 12 of these and more. Good examples, and most of them bad examples. But the key thing is understanding them and dealing with them and reacting to them. As Livermore said, there is nothing like losing all you have in the world for teaching you what not to do. When it comes to money, when it's a question of money, as Voltaire wrote here, everyone is of the same religion. We all fall, and what's going on in the world at the moment is a classic example of that, isn't it? Russians been allowed to sanctioned Russia for 4 years, suddenly allowed to sell its oil on the open market. Iranian oil that's out in tankers, suddenly being allowed to come on the market because of money, because of panic in the United States. What can I say? We are all of the same religion when it comes to a question of money. Very, very apt in the world we are living with at the moment. So we all I say these are not in any particular order, but these are 12 key things that we get wrong as traders. We tend to invest too little capital, or we'll buy an account that's too small, and we have expectations that are too high. So you might, invest £1,000 or £500, or buy a $10,000 trading challenge, and expect to react and to make money instantly. So if you'd say you'd invest $1,000, you might be expecting to make $500 within 2 or 3 days, because of the way our industry markets itself as easy money, sitting with your laptop by the swimming pool with your swimming trunks on, with all the cash in the world, your Rolex on your other wrist. That is high expectations indeed, and that's what undercuts people many, many times. So they'll come in very, very excited without little understanding of what's going on, certainly no idea about risk management or trading psychology, and just click away on tick charts or 1 minute charts when the price is moving up and down very, very quickly. And the other big one is that you tend to risk. I say most traders, most people in the world will risk too much on each and individual trade. The successful traders, the top 5%, those that stay in business for any length of time, is probably less than 5% as well. They know exactly how much they're going to lose every time they open a trade. So they focus on losing. How much am I going to lose when I lose? Am I still going to be in business if this trade goes wrong? How long am I going to hold this trade for? Where's my stop loss? Where's my target? Am I happy with the target? Am I happy with the stop loss? If so, we'll take the trade. Risk small amounts. Too many people, and this goes for, say, new traders as well as experienced traders, will risk far too much. They'll risk 10% of their entire account on one trade, or 50% trying to get back even. 20, 30% is not uncommon. It's far too much risk. If you're risking 1% per trade, you get 10 trades wrong. you're still in business. If you're risking 5% of your entire capital, you don't need to get many trades wrong in a row before you wipe your entire account out. It's simple numbers. Think about it. If you're risking, again, let's keep the numbers simple. If you were risking 10% of your £1,000 or $1,000 on your trade and it went wrong, you're down to $900. You've lost 11%. You've got to gain back 11% of what you've got left just to get back to zero. That's the simple numbers involved. As soon as you start losing and getting on a losing streak, it's very difficult to get back just to break even. And then that starts self-feeding itself. It's self-fulfilling sometimes. You've got to break the cycle, walk away. Many trading. I've done this as well all the time. You overtrade. You try to get back to even. You try to get your losses back. You're thinking about the next trade all the time, or you're thinking about the previous trades, whether it was a winning trade or a losing trade. You want to repeat the winning trade. You want to change the losing trade. Each and every trade is separate from the previous trade, but you've got to think in the whole. You've got to look at your whole equity curve. You look at your whole list of 50 trades, 100 trades. How did the whole portfolio do? The whole range of trades do, not this individual trade. Don't get too hung up on one particular trade. And as I say all the time, you've got to know yourself. There's no point in you trying to be a scalper and trading the tick charts or the 1 minute charts if you haven't got the patience and the discipline to switch very, very quickly from being long to being short on the same account. What's the best time frame that fits you, your personality, your lifestyle? Lots of people are very successful trading the 4-hour time frame because they're still working full time. So they can still check the charts before they go to work. They check during their working day, and they can check after they get back from work. And they keep the two separately. So they've still got their job providing income, and they're using their trading account not as a hobby, but they're using it as a separate business, a separate hustle to get better and perhaps one day do that full time with enough funds. And that, again, that's what the proptrade.com allow you to do. Get to be a funded trader. But you've got to trade the time frame that fits you as a person. What is the best one for you? Many people. I'm sure you've seen all of these next before. Ignore risk management. New traders in particular. So turning $10 into $1 million in 7 days. Yeah, that's the fantasy. That's the belief. But with risk management, please, it's really not going to happen. Trading in the Zone, I say, Mark Douglas's book, one of the best around. Bruce Kovner, and another great one of the heroes of mine. My experience with novice traders is that they trade 3 to 5 times too big. They are taking 5 to 10% risks on trades when they should be taking 1 to 2% risks. You can get rich by risking 1% per trade. You can be successful getting 50% of your trades wrong if you've got your risk management correct and still make money. There's not many businesses in this world where you can be successful getting things wrong 50% of the time, can you? Imagine an accountant getting his sums wrong half the time, getting 5 out of 10 in his maths exam and still being successful. You can do that in this crazy world of trading. But it's all about knowing yourself, and it's all about managing your risk. Market Wizards, there's 7 or 8 books. I think there's a new one coming out soon, isn't there? By Jack Schwager. I think it's 7. Yeah, he first published these 30 odd years ago. Jack, futures trader himself, but a great interviewer of people, a great making people comfortable talking about their trades. When Market Wizards first came out in the late 80s, traders were unknown. We didn't have the internet. We didn't have the 24 hours TV channels. We didn't have the finance tellies. TV channels all the time. They were unknown people and they were very reluctant to become public, and you didn't see their faces. Jack had this ability to get them to talk and open up about how successful they were, and over the whole series of books, the 7 or 8 of the Market Wizard series, you see the same traits all the time coming through successful traders, whether they're new guys now in 2020, or back in 1980s. It's the same sort of traits, the same sort of personalities. And there's different personalities going to be successful traders, but it's all about understanding themselves and what makes them tick. And they're all about managing risk and going for it when they're winning, understanding when they're losing, to cool down, to stop completely with some of them, reduce their risk, reduce their exposure to the market, and then coming back to fight another day. So Market Wizard series of books from Jack Schwager, another great series of stories of successful traders and what makes them tick. Uh, we do not see things as they are, as we see that. We do not see things as they are. We them as we are. We see them as we want them to be. Basically, it's not a strategy that wins big. It's the mindset. Spend as much time preparing your brain for the session or the trading day as you might prepare on your chart. Trading is not charting. Fundamental analysis. It's not all about you. It is all about you. Sorry. And that's the key thing to understanding yourself. 5 to 8 of these top 12. So many. Even now, I see so many people that never trade with a stop loss or a take profit. The beauty of with a stop loss and a take profit is you've got a break, again, a psychological break for your brain. Where your stop loss is. 99% of the time, it'll be hit and it'll be successful. Obviously, sometimes there's slippage and particular volatility, and we can go crashing through your stop loss. But just think about if you didn't have a stop loss and you got this massive volatility, this massive slippage going on, you never know when to get out, and you'll click, right at the bottom of the panic, and end up wiping accounts out. Many people will, buy here and it goes up and goes up and goes up, but then it suddenly starts to come down. It comes back under their entry. So it was green, they were in profit, and then it's negative, 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 and don't worry, it'll come back. It'll come back up. I don't put a stop loss on because brokers and my institution, they always know where my stop loss is. They'll go hunting for it. They'll hunt the liquidity sweep will take me out. Yes, that does happen to an extent, but brokers aren't bothered about your small $50 account or your $10,000 account. The market is what the market is. It goes up, it goes down, and it's driven by these very, very sophisticated computers, these sophisticated algorithms, trying to match all these buyers and sellers up at once. And if there's a cluster of sell trades down here, the market will try and get to them sometimes if there's too many. So be careful about putting them around key areas. But it's not the massive crisis that you think it is. It's not. Brokers are the market's too busy. The market is too volatile. There's too many people. There's millions of people, billions of people trading at any one time, or institution trades going through at any one time, to actually look particularly where your stop losses or anything else. Number 6 here was one that I found really, really difficult personally. I couldn't accept losing. I wanted to be right. That was my big issue. Again, because of my personality, I'm a bit of a big head. I'm a bit of a know-it-all. I certainly was when I was younger, and I am still to an extent, just as my wife. A bit of a pain in the arse, to be honest, but not accepting losing. I just wanted to be right. I didn't mind. Well, I did mind losing. I'm kidding myself. But it was actually being able to accept that you're losing. And again, one of the key mantras of mine is you've got to accept losing trades. You've got to accept losing trades. If you've got to stay in business for any length of time, you've got to be able to accept losing trades. And winning 6 out of 10 for many people just isn't good enough. Remember when we were at school or at university, at college, or when we were kids with our parents and grandparents, getting 6 out of 10 in your maths exam, for instance, or 60% on your essay at school, or in your woodworking class or metalwork class, or whatever it happens to be, that doesn't seem very good, does it? But again, successful traders, 60% is a really good hit rate. 75%, 80%, fantastic. You're in the top 5% of traders over a period of time. Anybody Anybody can have a 9 out of 90% hit rate for a couple of weeks or even a couple of months, but to maintain that over any length of time is very, very difficult in this business because the market is constantly changing. The market doesn't change either very much, ironically, but it's also constantly changing. That's a bit of an oxymoron, but that's what happens in the trading world. So it's all about, again, knowing yourself, accepting you're going to have sometimes a long run of losing trades, 9, 10, 12 losing trades in a row. But if you're only losing a small percentage, you're only losing 1 or 2% on each of those trades, you live to fight another day. Excuse me, I need another drink of water. So accept losing. Similarly, you've got to be able to accept winning. Again, that I know a lot of people that have freaked out when they've been trying for years to be successful, and then for a few months they become successful. They can't cope with it, bizarrely. They like I know it sounds really strange, but I know many examples. They found the struggle part of what they wanted, so they like the struggle of trying to find a system that was working for them. And when they eventually did, they couldn't believe it, and they couldn't repeat it on from time to time. And that's why you find sometimes when you see people that work, traders that work for banks or for big institutions, whether it's even family offices or big fund managers or big banks, find it very difficult to trade their own money, and they're not successful. One of the most successful teachers of traders and successful traders of all time, the guy that created the turtle traders, he found trading his own money much more difficult than trading other people's money. So it's just what we are as human beings. It's understanding that. Okay, many people never have a trading plan. Don't write it down about why they're trading. Why are you doing this? Just to make money? I want to make money. I want to quit my job and trade full time. Well, that's great, but that isn't a trading plan. Write it down. Understand what your goals are, what your limitations are, what backup resources have you got. Are you trading with money you can afford to lose? If you can't afford to lose that money, inevitably, that's going to sit in your subconscious. Your subconscious mind knows that. If you put money on a credit card, you know that that's got to be paid back at some point. The interest rates are huge. That sits on your subconscious. Puts pressure on you trying to make money. So if you're going to try and quit your job and trade full time, you need money to survive, to pay the rent, to pay the mortgage, pay the school fees or whatever it is, to get the kids dressed, clothes, food on the table, pay the energy bills, which are going mental at the moment, aren't they? Have you got enough capital to do that, and then enough capital to trade with? Most people don't do that, and they underestimate all of those costs. The key thing, though, is, as I keep coming back to it, is the soft skills, the patience, the discipline, the ego. Ego gets in the way all the time of everything we do, and in trading, it's the worst possible outcome. Too many people are in a hurry to make money because of what they've seen in the marketing leaflets. As I say, I've written there, turn the telescope around. The successful traders, the ones that stay in business, function by understanding how much money they're going to lose if it goes wrong. The process keeps them in business, and the winning trades just come along and they pay for themselves. They don't panic when they're suddenly in profit. They let the trade run. Their stop loss is far enough away to deal with the volatility, whether it's over a few seconds if you're a scalper, or if you're a long-term investor over days and weeks sometimes. So patience, discipline, leave ego at the door, and leave hope at the door. As I say, there's two outcomes to a trade: you win or you lose. How much you win and how much you lose, that's down to you. That's down to your stop loss, down to your take profit. But think of it in percentages, not in absolute dollar terms. It takes a lot of the stress away, because you will inevitably have losing trades. And again, too many, particularly novice traders, never ever think that way around. They only think about winning. They only think about how much money I'm going to win when that trade completes. This is a great setup. This is a perfect setup from this system. This is the greatest EA I've ever seen. You know, look what it's all done. Look what all this stuff on the internet. This works really, really well all the time. But it might do for Joe and Jenny and Stanley over there, but it might not work for you because you're a different setup. You know, I've been teaching this for years and years and years. I do this in live forums. I do this in live rooms with people. You know, I've been teaching 20 people on live markets, on live feeds with everybody's using the same laptop or more or less. They've got exactly the same setup, the same broker, the same platform. You know, 3 or 4 people out of 20 will make money. 16, 17 of them will lose money, even though they've been taught exactly the same approach. And that's because some people think they know better than what's going on. They'll take too much risk. They'll have the wrong volume size, even though, the wrong lot size, even though they know they shouldn't do it. You know, you get people to write stuff down. They know they're doing it wrong, but they can't help themselves in the cut and thrust of the live trading room. It's just what we're like as human beings. And once you recognize and understand that and accept that, that's when you can start doing something about it. So patience, discipline, writing stuff down, coding it all helps in the long run. You know, there was a great survey done some nearly 10 years ago now, I think it was. 25,000 traders, 43 million trades over a 15-month period done by a company at FXCM. I think it's 10 years ago. The win rate of those 43 million trades and those 25,000 trades, massive sample size, isn't it? 15 months. It wasn't just over a particular trending area. It wasn't over a particular asset. It wasn't just a particular season and only a few trades. 60% of those traders were winning. And that's what I'm saying. So most strategies, most approaches that you find you've developed, they are successful enough. 62% win rate. But the problem was, people were losing more when they lost than when they won. So the average pips or points was a 48 pip gain, but the average loss was much, much bigger, 82 pips, 82 points. So although they were winning 60+% of their trades, 6 out of 10, they were winning. For every 48 pips they were winning, they were losing 82 pips. So you do the maths. Overall, each trade, you're 140 pips out. If we did it the other way around, if we had a 62%, we still have a 62% win rate, but our average win was 82 pips and our average loss was 48 pips, and that's what the successful traders are. The difference is massive. So from a negative 140, we go to a positive 326. Traits of Successful Traders is the link if you want to find it. So it was FXCM carried out against their traders, against their book. I think it was 2015 when they did it. But fascinating stuff. And again, I've done similar analysis, brokers I've worked with, and similar win rates. Some of the win rates weren't as high as that, but certainly the pips won and the pips lost were much more exaggerated as well. There tended to be the pips won were less and the pips lost were higher, if anything. So, but I had a smaller sample size, but this is a huge sample size. So, but the story is still the same. Most people, regardless whether you're getting, even 80% win rate, even with an 80%, 90% win rate with those numbers, you'd still end up losing money, wouldn't you? Because what's happened is it's that psychology again. People hang on to losing trades, think they're going to come back, and never cut them. You've got to be disciplined with yourself and say, where you're an end of day trader or a scalper on the minute time frame, when it's hit your stop loss, it's out, it's over, finished. Well, that is if you've got a stop loss. A lot of people don't have stop losses, like I said before, so they hang on to it and hang on to it and hang on to it, or they'll move the stop loss down or move the stop loss up. If they're depends which way they're going, obviously. And then there's obviously charges for holding overnight with certain types of trades. So it's all about just accepting you have lots of losing trades and keeping those losing trades small. And then don't look at them and think, if I'd only held it a bit longer, it came back eventually. Well, yeah, but so what? There's lots of other opportunities all the time. There'll be another new trade coming along. There's this ocean of trading I'm talking about. There's always a new opportunity coming along. Timing is another thing. If only then, that's a similar sort of thing. A lot of people give up too quickly. Might give up after 10 or 20 trades because they've risked too much. They've blown their $1,000, $2,000, $10,000, $50,000, whatever it is, because they're risking too much. Typical. You need I would argue, to get a good sample size, to get a good a statistical relevance, you need at least 100 trades. How are you going to get 100 trades if you're risking 10 or 15% of your account? If you have 5 losing trades in a row, you're never going to get there, are you? And getting 5 losing trades in a row is nothing. Has everybody heard of the? I don't know. I've got the slides on here, but the Monte Carlo casino, one of the most famous casinos in the world, the Monte Carlo effect, where they had the red and the people betting on the red and the green. It was back in 2013, I think, 1913, I think it was, and they had something like 29 or 30 consecutive balls falling just in the red zone, and obviously people were betting that can't, after the 5 consecutive red wins, it's got to fall in the black now. 10 consecutive red wins, it's got to fall in the black now. I can't remember if it was black or red. I can't remember which way around it was, but it's it's the Monte Carlo fallacy. It's called. Look it up again. You get lots of losing trades in a row, just like you get lots of winning trades in a row. But you've got to be able to deal with that emotionally as well as financially. So write stuff down. I know brokers the world over now will log all your trades, and they send you the account at the end of the month and all the rest of it. But write stuff down, put it in a spreadsheet, put it in a book, whatever you want to do it. But certainly understand yourself. What's your winning rate? What's your longest losing rate? What's your longest winning streak? What's your average winner look like? What's your average loser look like? What's the best day for you to trade? What's the best time frame for you to trade? What's the best asset for you to trade? If you don't know all of that data, stop now and just analyze what you're doing. There's lots of different bits of software now that analyze all of this for you. As I say, when I started, and I still do it, I do it in longhand, write it down in my trading diary. I love this one. This is one I got in Tokyo in November. This is the naughty one for 2026. Write stuff down. Write your numbers down. Understand your numbers, because that's what keeps you in business. And obviously, and it goes without saying, understand, what a pit value is, lot size, risk management. What can I say about risk management? I can't say enough about risk management. Over the years, there's lots of things people have told me they do wrong. I'm not going to read all these out. I'll just leave them on the screen. But it's greedy, not being able to put a stop loss in, feel like it was the right position. Don't go the right way. Not trading with a stop loss. Not trading with a target to take profit, and then all of a sudden it turned around and gone against me. Dealing with that fear and greed. Taking profits too early. Lot size too big, over trading too much, trying to trade everything, not waiting for the setup to complete. If you've got 3 indicators, going after only 2 indicators have corrected. The candle hasn't completed because you're waiting for the hourly. You're trading on an hourly time frame, but you open the trade after 30 minutes. Things can change very, very quickly. These are real quotes from real people. Why do you hang on to losing trades? All sorts of things, all reasons people lose. So the things you need to focus on psychologically, as well as you, is understanding yourself, your core beliefs, understanding risk management and money management. That money management and risk management are 2 different things. It's still all about the numbers, but it's managing your risk as well as managing your account and your money. And for me, it's very much about doing what's probable. Keep it simple. So when do you trade? All day, every day, around your work, around your lifestyle. When can you trade? Lots of people will trade because they've got this time frame. It might not be the right time for them to be trading. It might be completely the wrong time. So find what works for you. Know yourself. It's all about emotional control. How emotional are you? Can you deal with long losing streaks? We are dominated by our emotions as traders. And the key ones, fear and greed are the two ones that drive traders. Obviously, there's hope, regret, all those sort of things. But as I say, abandon all hope. He who enters the trading room, hope dies last. But in trading, abandon all hope, whether you win or whether you lose. Lots of fear in trading: fear of making a loss, fear of missing a trade, fear of losing a profit. That's the worst one, isn't it? You've seen a trade go in your direction, then all of a sudden it starts turning around, and all of a sudden your profit has disappeared. And what was a winner, or possibly a big winner, didn't quite get to your target, but all of a sudden it's a loser, and it's loser, and all of a sudden it's hit the stop loss, or it gets really, hits the stop loss, just goes a little bit low, and then it bounces back and actually goes up to your take profit eventually. That's they really get to you, and they still get to me these days. But that is what happens in the trading world. Can you deal with it? Greed. Gordon Gekko said in the famous Wall Street film of 1987, a long time ago, greed is good. He didn't actually say that in the film, but that was his mantra, wasn't it? Greed is good. I know from my own experience, as I say, no, it's not, says SC in 2000. The first big internet bubble, 1997, 98, 99, the markets were just going gung-ho, a bit like they've done with the Bitcoin and crypto bubbles over the last few years. But all of a sudden, it all started to fall apart in the first quarter of 2021, and markets collapsed really, really quickly. I remember being on the phone to my broker, and it was just ringing and ringing and ringing, because that's what you had to do back then. And I couldn't get through, and the price of this thing I'd bought as penny share had rocketed thousands and thousands of percent, and it was just collapsing very, very quickly. And it, lost whatever it was percent, just literally while I was on the phone trying to get the trade closed or take some of the profit off the table. So, it's managing the fear and greed. You can't get rid of them because we're human beings. It's about bringing that subconscious thought, that little voice in your ear, to the front part of your brain, your frontal cortex, and accepting and dealing with it. Okay. For me, longer time frames equals less emotion equals better decisions. So I made most of my trading, less so now, but I do a lot more short-term trading than I used to do. I enjoy a bit more on an end of day basis. Set and forget. The price finished here today. I've entered or I haven't entered. Stop losses here, targets there, and just wait, see what happens. Know yourself, reduce the emotion, fear, frustration, and failure, all part of the same fear of trading. What's the difference between me stood here in my little office, my new office up here on the second floor, than these guys? Know yourself, reduce the emotion. That is proper scary stuff, and it's free. These free mountaineers. I'm stood here in a nice little office, all nice and comfortable. But that's real fear, isn't it? It's a mindset business. Look yourself in the mirror. Get a mirror. How do you deal with risk? How do you deal with all these things we've talked about? Those 12 losing things. You are your competition, not the broker, not the latest movement in the gold price, not the gurus. You is who you've got to be. These numbers here I took from a book called The Best Loser Wins. It was published a few years ago. Really, really good book. I fully recommend it. I'll come on to it in a minute. But, know yourself, reduce the emotion, this fear. I let my losses run because I'm hoping, because my subconscious is avoiding the pain of taking the loss. I let my losses run because the indicators say so as well. It's still above the 50-day moving average, so it must be positive. I'm avoiding pain. This is all about our brain keeping us safe, because that's what our brain does. Fight or flight. That's what the adrenaline. When we see a stressful situation, we either confront it or we run away from it. And our brain is trying, as over millennia, has kept us safe by avoiding the pain. Okay. I'm losing, so I increase my stake, trying to get back to even to avoid the pain of losing. I'm winning, so I'm reducing my stake. Phew, pressure's off. Thank God. It's hit, it's got off. I've bagged that profit. I've made $20 after all that stress. But the prices continue to move up. I didn't have I got out before my stop. I got out before my target because it had been loss, 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 loss. And remember, every single trade we take, guys, every single trade we take, as soon as we open it, we're in loss, aren't we? Because of the spread. No matter how tight the spread is, no matter what brokers you turn, you're always in loss. It's always negative. Always losing as soon as you open that trade. Because remember, the spread. You might see on your charts, you might see the mid price, you might see both prices. Depends how you got your chart set up. But normally, you see one or the other, and you're always negative. Whether you're going long or going short, you're always out of the money. And that can go on for a long time, long time, long time. Out the money, out the money, out the money. Oh, out the money, out the money. Comes back, comes back. Oh, made money. Get out. Take the P rate. Avoid the pain. I made my target, so I stop. Afraid of losing what I might have made. That's another one. Something that's it's changed my mindset about adding to winning positions or adding as it's going up. Trading on emotion with no conviction, no plan. You're bored, you're scared, you fear of missing out. FOMO, massive one in the trading world. People missing out. That's why prices tend to go up. People buying right at the top as the smart money's starting to roll over, starting to get out. Avoid the pain of missing out. All about avoiding pain. So for me, I summarize it as PDC: patience, discipline, and control. Patience is a bitter, but its fruit is sweet, said Aristotle. Scared money never wins. Trade what you can afford to lose. Do not use borrowed money. All that stuff I've talked about before. Risk management, absolutely key. So you've got to be patient and disciplined. Wait for your levels. Wait for indicators. Wait for the candles to close. Write a plan. Have a plan. It's all about process, and stick to your plan, even though you're losing, or even though you've got a few winners. Just keep repeating what you're doing. That's the simple thing. Repeat and control. Keep the fear and greed in check. You can't get rid of it, and everybody tells you you can. They're not telling you the truth. They're lying to you. Get rid of hope and desire and regret. It's just part of the process. You either win or you lose. The key thing about keeping calm and in control and your emotions under control is when you lose, you're not losing too much. Despite it might be your 20th losing trade this month. It's just part and parcel of what happens. And in Larry Hite, we talked about Larry Hite earlier on. It was one of the original market wizards. His 1% rules. I don't trade for excitement. I trade to win. Some people do trade for excitement. They do trade for the idea of just trading or telling people they were a trader. Those people I was talking about before about couldn't cope with actually when they became winning. They liked the idea of trading, they liked the idea of excitement. So whatever your rule is, whether it's a fixed amount of money, a percentage, I always recommend a percentage. You can stay in business if you keep your losing trades small. Patience, discipline, control. Patience is everything. It's getting worse because of the state of the instantaneous social media world we live in. There's no shortcuts. Practice, write stuff down, practice, patience. Big breaths when you're losing. Slows your heart rate. That sweaty palm. Panicking about. Turning your device upside down. I did that a few times. This is triggered as a long trade. So you should turn the laptop screen upside down. Would I still take it if it was a short trade? If it's as good as looked as good going short as it was going long, still take the trade. The very first line now, it says patience, practice and practice patience. I remember the very first trading manual I got, sent off from a guy called Peter. I've forgotten his name now. A long time ago, in the mid 90s. Peter Hall. It was Peter Hall. Was it Peter Hall? No, he was the director, wasn't he? Anyway, it was a big ring binder. The great big file. It's 300 odd pages in it, and the first page was read this and it was first page. Don't read any more for 24 hours, and it was the idea of testing our patience. And of course, I turned over at home. So we got the manual at home. Then we went on like a 2 or 3 day course down at his very flesh place down in Somerset. But I didn't, I didn't have the patience and discipline then as I started. Like 99% of the people that attended the course didn't. They obviously all turned over the page onto the next one. But that was just an example of having rules and doing as you're told. And there's a reason for doing this, because it means you can follow this process and you can be successful. The elastic band story here, again, that was something I did on so it was on my left hand. So trade was coming. This is when I was starting to trade short-term timeframes, 15-minute timeframes, and just before I'd pressed the buy or sell button on the broker's platform, I used to sort of just ping the elastic band. Just sort of brought me back to calm down a bit, take a step back. Is this still right? Yeah. I didn't do it for very long. It was not painful, but it just felt like a bit of a prat. But it worked for a little while. So hang on a minute, slow down, calm down. There's no rush. And one that worked really, really well for me when I had a bigger room, a bit bigger than where I am now, I would have my analysis on one desk, on two screens over here, but my actual brokerage was on another laptop across the room. So the analysis was being done here. This was on sort of an hour and 4 hour timeframes. The analysis was getting done over here, and I was pretty good at that. But the process, so that was saying, yes, this is going to trigger in the next 10 minutes as the hourly comes up. But the process of getting up from here to walk across the room to switch on and activate the trading platform here sometimes made me think again, and sometimes the trades wouldn't be taken. So it's all those sort of things that worked for me. All these tricks have worked for me in controlling and finding myself and my trading career. So distract yourself. Go and do something completely different. Look at your trading. What specific can you improve? Is it your risk, your capital, your time frame, the assets you're trading? All that sort of stuff now these days. You can get all sorts of different bits of software that can do that for you. Whether it's anything from my FX book to buying actual trading analysis, trading journals that can be all automated. Writing stuff down. I'm old-fashioned. I still write stuff down, but it works for me. I'm not saying it works for everybody. Just find what works for you. Sweaty palms. All the time. Richard Dennis, I touched on Richard Dennis before. Dennis and Urquhart, they did the Turtles, 23 novices. They put an advert in the Wall Street Journal in the 1984, I think it was. And he had a very, very simple trend following strategy. And some legendary traders were born as part of the Turtles. Dennis believed that trading could be taught. Eckhart thought it was more of an inherent ability, but very, very standard. It's available now, but made hundreds of millions of dollars for himself and for Eckhart and for the traders that developed from that. Very simple, a trend following strategy. All about his end value, which is basically his risk, his volatility, his end value. We use that's why I first came across this, and then it's very, very similar to the ATR, the average true range. Used 20 and 55-day highs or lows, and it's all about managing the trade size and the rules that traders had to follow. Lots of books about that. This is Eckhart later on. Amateurs go broke taking large losses. Professionals go broke taking small profits. That's Eckhart's quote. We could post our trading. This is a famous quote from Dennis. We could post our trading rules on the front page of the Wall Street Journal, and still people would not be able to make money from them. A bit like what I was telling you about when I was in rooms teaching people, 20 of us there using exactly the same rules, exactly the same systems, and 3 or 4 of us would make money. Most of the others would lose money. It's exactly the same principle that the Dennis was talking about here with his simple strategy, because that's the strategy. Sorry, let's just go back to the obviously at the time in the early 80s, this was people were the original turtles were sworn to secrecy. Complete novices, all these people from different walks of life, different levels of education, different parts of the United States. They all came to Chicago. But there's the rules there, and as he says, you could have published those, and still people couldn't apply them because they couldn't stay in them, they couldn't follow the rules, couldn't stick to the rules. But as I say, some legends now from 40 years ago of the trading world were original turtles themselves. I'm not going to run through this, but this is a prospect theory by Kahneman and Stravinsky from 1979 about how we deal with risk and reward, risk management, gains and loss, and how we deal with it. So I use this in a room with people with hands up, but basically it tells us as we go through it that most people, two questions. Both the popular results choices were irrational, as they chose the smaller expected gain or the greater expected loss. And the reason is because it's a quirk of human nature that regarding risk and gain, we are risk averse when it comes to gains, but risk takers when it comes to avoiding a loss. Okay, so that's why we'll let our losing trades run and close our winning trades too quickly, and that's the exact opposite of what you want to be as a successful trader. And trading explains why traders let I've just said, losses run and cut their profits. The exact opposite of what we should do, and it really, really is a mindset business, trading. And that's this was back in '79 when we first looked at prospect theory. So, in summary, we are all about ourselves. It's all about understanding ourselves. These were questions that came up the last time I ran this webinar. Do you have rules to prevent revenge trading or overtrading after a loss or a win? How to handle drawdown, because in this situation, most of the traders lose control and fails their account. Yes, I mean, you just be aware of it. I know it's easy to say, but don't overtrade. Don't try and revenge trade, because the markets do what the markets do. If you've had a running series of trades on the DAX or on copper or on gold or whatever it is you're trading, try and perhaps and look at another asset. Or why has this happened? Is your approach not working anymore? The idea about avoiding that question how to avoid revenge trading and emotional trading, it's very easy. Just don't do it. It's very, very easy for me to stand here and say, just don't do it. You avoid revenge trading and emotional trading by having a structured process that you don't know that works, obviously, initially. But if I've got a $5,000 account or a $10,000 account, I've lost X% today, and as I said, you want that around about 2%. You've lost 2% today. Stop, quit, finish. Analyze why that happened. Just one of those things. It is part of trading. News came out. I shouldn't have my lot size was too big. If you are following your process, if you are following the rules, that means you have a stop loss. That means you'll only lose 1% or less than 1% on each individual trade. You stay in business long enough with real money and real funds to analyze what's going on. I'm not saying you're not going to blow an account by losing 1% every time you trade. Of course you can, but you've got a much higher chance of success by doing that than if you risk 5 or 10% on each trade, and then have one big winning trade that gets it back, but then all of a sudden you haven't learned anything then, or you're always following indicators from somebody else, or instructions from somebody else, or some black box, because you're not learning anything. You're just following what other systems are doing, other people have developed. are doing. So find what works for you. You know, if you could only teach one lesson to your past self when starting out, what would it be? It would be to accept losing trades, like I said at the beginning. I came into this business like lots of people, wanting to make money, not needing, but wanting to make money. I had enough money, and I knew if it all went right, it wasn't going to affect. I could still pay the mortgage and still, put food on the table. It was something I quite enjoyed, and I still enjoy it to this day. But it would be accepting losing trades. How do you deal with emotions while trading? I just wanted to gather some insight on how to deal with emotions when trading. How much shall I be risking in each time I trade? Well, as I say, 1%. I'll say these are real questions from before. How is forex trading different from gambling? Because, I haven't touched on gambling at all. Gambler's mindset, apart from the words I talked about when I talked about the Monte Carlo fallacy. It's having a process, whether it's forex trading, whether it's trading gold, whether it's crypto trading. It's knowing the asset that you trade. You know how it moves or it doesn't move. Is it in a trend? Is it going sideways? What's the appropriate strategy at this point in time for this time frame? All of those sort of things. A gambler, I know lots of people that like going to the casino, take £500, know they're going to walk away with nothing, and accept that. So it's you could argue that is a bit like trading potentially, but the gambler is gambling against the house. The house, tends to always win because things are in their favor. Typically, and gambling, people quite often do it as a hobby. Quite often do it as a way of relaxing for some people. Obviously, it can be quite addictive, and it can become a big issue for many people, and it can be very, very socially divisive. So again, it comes back to knowing yourself. If you have that gambling mentality or that susceptibility to that mindset, be very careful about not have a very strict rules, and can you stick to those rules? And again, I would argue that the gambler obviously clearly doesn't have any rules. It's chasing each and every trade, or each and every horse, or each and every dog, or whatever gambling they do. So that's how I'd say is different. Sorry, I've run over the hour. It's gone a lot quicker than I thought it was, and I've got through more slides than I thought I would. My three favorite books are certainly when I first started, and I've touched on these already today. Get them, read them more than once. If you have to buy just one, Trading in the Zone by Mark Douglas. Master the market with confidence, discipline, and a winning attitude. At the beginning of the book, there's a 20-question simple yes or no answers. Do the attitude survey. Read the book. The attitude survey is also published at the back of the book. You'll be amazed at how your attitudes will have changed once you've read and absorbed the book, and read it. Not as like as a hobby. All three of these, obviously non-fiction. All three of these books are timeless. Basically, you can dip into them. All of them many years old. Reminiscent of Stock Opera, it was first written in 1929. Trading in the Zone was, I think, first came out in 1999, and the first Market Wizard books came out in the late 80s or early 90s. I can't actually remember off the top of the head, but the long time ago. There's Mark Douglas, bless him, we lost him a few years ago. When you achieve a complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with trading will end. That's all about. That's Mark Douglas in a nutshell. Acceptance of the uncertainty. You don't know what's going to happen when you open that trade. You've gone long here. Somebody else will have gone short here, and the price will either go up or the price will go down. You either win or you lose. This guy here, or this trader here, she thinks it's going down, so she sold it. You think it's going to go up, so you bought it. One of you will win, one of you will lose. You're not trading against each other, you're trading against the market. So, in each and every time, that is, as Mark says there, the uniqueness of each moment, your frustration will end. So it's allowing yourself to get control. It's allowing yourself to get consistency. and it just is what it is. Accepting the risk means accepting the consequences of your trade without emotional discomfort or fear. That was a big phrase I took on board when I very first read Mark's first book. So the 7 steps in is the not discipline trader, the trading in the zone. The 7 steps within there are, what you understand, what you need to learn, deal with losers. Again, we've talked about that a lot today. Expert in one market behavior, whether it's going long, going short, the opening, the way the market opens at a close or open, whatever it is, execute, process, execute flawlessly, a system approach flawlessly, execute, process, thinking probabilities, be objective, not subjective, and analyze or monitor everything. There were the 7 steps that Mark wrote 30 odd years ago, and none of that's really changed over time. We're bringing things right up to date. I touched on Tom Hougaard earlier. The best loser wins. This is about Tom's very much approach. Big, on the side of psychology. Both of these guys, Steve Goldstein and Tom Hougaard, about adding to winning trades. That was Tom's big one of Tom's big messages. And the best loser wins. Why normal thinking never wins in the trading game is absolutely correct. And both of these books very much in line with my thinking. And I wish I'd written these books myself. I could have, but they say it's a mantra that I've been banging on for years and years and years. And these guys have executed that much better than I could have done, and explained much better than I do. But certainly 2 books you should have a look at and get copies of. Tom Hougaard, The Best Loser Wins, in lots of different languages now. And Steve Goldstein, the guy that runs the Alpha Mind podcast as well, Mastering the Mental Game of Trading, 30-year career trader in the City of London, harnessing the power of the inner self to fuel trading outperformance. That's very, he has this workflow, bit like Rich Dad Poor Dad quadrant, 4 quadrants with Steve as well. But 2 really, really good books all about trading psychology, basically. So that's it, guys. I hope that's of some use. I hope you've picked something out of it. But as I say, if you take one bit away, just take away, you've got to understand yourself first and foremost. What type of person am I? And therefore, what type of trader am I? How do I manage risk? How do I manage losing? How do I manage winning? All part of the same portfolio. But that's the key thing. It's not charting. It's not fundamentals. It's not what Donald Trump says. It's not what your broker says. It's not what I say. It's about you. So the best of luck. Thanks for listening. Thanks for watching. We'll see you all again tomorrow. Theproptrade.com is where we are. Come and check us out. All the best, everyone. See you soon. Take care. Bye-bye.